But I keep hearing the S word recently, and that's for stagflation, and that's what we're digging into on today's Stocks in Translation. First, let's get our terms straight. Stagflation here means three warning lights flashing at once: weak or negative growth, high unemployment, and high inflation. Stagnation plus inflation. And some folks draw a line between capital S, the 1970s kind of stagflation, and the lowercase s when only parts show up. And since the pandemic, we've really only seen the lowercase kind. So let's break down the three major components right now. Starting with economic growth, we have GDP, or gross domestic product. It's the home field scoreboard. It's what's made inside our borders, and gross national product, or GNP, tracks what Americans earn anywhere on the planet. You also have gross national income, GNI. It rolls up wages, profits, and taxes, less subsidies. And fun fact, economists often watch GNI when profits or labor income look out of step with GDP, like right now. Then there's inflation. You've probably heard of the Consumer Price Index, or CPI, which is a household shopping basket. There's also personal consumption expenditures, or PCE, which is a broader base instrument, and it adjusts for substitution, and that's why the Federal Reserve likes to use it. And we should also distinguish between so-called headline inflation from what's called core. Headline includes food and energy, while core strips these volatiles out to see the trend. And for jobs, we watch the unemployment rate and how many payrolls are added or subtracted each month, courtesy the Bureau of Labor Statistics. We also like to watch the weekly filers for unemployment claims, since it's higher frequency. If claims start climbing while payrolls fade, that's part of the stagflation case gathering clouds. Now, let's check the history. Here in this table, we can see that in 1975 and 1980, we had a capital S, unemployment north of 7 or 8%, double-digit inflation, and contracting output as GDP plummeted. We didn't really have anything close to that until the pandemic in 2020, but there is a key difference. In the early days of COVID, unemployment spiked and GDP fell off a cliff, as we remember, but prices didn't rise yet. Price inflation actually dropped to nearly zero in 2020, which is almost deflation. So it was stag without inflation. But by 2022, all the stimmies finally started jacking prices higher, north of 9%. The economy shrunk modestly, but joblessness stayed low. That's only 2 out of 3. And today, unemployment is modest, PCE is in the high 2s, and GDP is fairly strong. Definitely not 1970s territory. And we'd be remiss if we didn't point out some market stats. It can be tricky to trade stagflation, and as I just said, that's really not even the case today anyway, but one thing's for sure, precious metals are soaring. Gold is up 40+% this year, and silver is approaching 60%. Metals love elevated inflation when the Fed is cutting interest rates like right now. So here's what we want to watch for in the S checklist. On the data front, we're going to continue to watch jobs and CPI and PCE and GDP. We're especially keeping an eye on services inflation, as well as shelter, insurance, and healthcare costs. If these cool down, then core inflation cools as well. Then watch energy and the dollar. An oil pop or weaker dollar can reheat headline inflation pretty fast. And finally, this is a little tricky, but we want to monitor real incomes versus demand, which means workers' paychecks after inflation, and to make sure that they're growing faster than spending. Are people starting to dip into their savings and rack up their credit cards? That's a yellow flag. Bottom line, right now there is at least a chance of lowercase stagflation risk, but it's unlikely to get anything like what we saw in the 1970s or 80s based on what we're seeing right now. But if all three lights turn green, growth, jobs, and prices, well, guess what? That is your stagflation siren. And tune into more episodes of Stocks in Translation on the Yahoo Finance's website. We have new episodes dropping every Tuesday and Thursday.
The stocks are pulling back to start the week after notching new record highs on Friday. Still, September is defying its reputation so far as a historically weak month for stocks, and many Wall Street strategists say there's still room to run. Joining me now, Thomas Hayes, Great Hill Capital Chairman and Managing Member, here with us in the studio. Tom, it's good to see you.
Great to be here, Julie.
So let's talk macro for a moment, and this little bit of a pause here this morning, but we've had this big upsurge.
Yeah.
Anything, you've been pretty bullish.
I have been bullish, and that's worked, but I do think we could be due for a pause. There's an old Wall Street maxim, you've been around, sell Rosh Hashanah, buy Yom Kippur.
Right.
And more than 2/3 of the time, this last week and a half of September tends to be a weak time, on average down about 0.4% in the S&P 500, 0.5% in the Dow Jones Industrial. I think that's the bad news, Julie, so maybe a little short-term volatility.
Yeah.
The good news, you got so many tailwinds. Number one, you got consumer sentiment completely washed out at levels not seen since the COVID lows, and prior to that, the European debt crisis in 2011 and the great financial crisis in 2008. What happened 12 months later when consumer sentiment was this low and washed out? S&P was up 24.1%. The other thing you have, as we know now, is the tailwinds of the Fed cuts. And if right now, market's expecting 4 to 5 cuts over the next 12 months. In an expansion, if we don't go into recession, we're showing no signs of immediate recession. GDP is still positive. You have up 16.1% over the next 12 months. And then you got earnings accelerating. So estimates for next year, 13.7% earnings growth, up from $300 a share to $305 a share. So I think the theme is going to be pick your spots, because maybe the indices don't do quite as well prospectively as they've done in the rearview mirror the last few months, but under the surface, some tremendous opportunity.
Okay, where's the spot?
Okay, well, first thing, we've got a 4 times in a 100-year opportunity in small caps. Small caps valuation relative to large caps has only been this low. This will be the 4th time in 100 years.
Okay.
Last time was the early 2000s. Over the next 6 years, you had dramatic outperformance. Fed cuts are a huge catalyst for this because they can refinance their debt. They have faster earnings growth relative to the S&P. They have a lower multiple relative to the S&P. So I know a lot of value guys and girls have been calling for small caps for
really? I haven't noticed, Tom. I don't know what you're talking about.
But for all of our technicians out there, they're actually starting to break out. Not that the fundamentalists really care, but it's a good sign. They are starting to break out, and now we finally have that Fed.
Okay, I'm going to ask you the same thing I asked one of your peers on the street who was also talking about small caps last week. I just, for fun, went back and looked at the relative performance of small caps versus large caps.
Yes.
10-year period, 20-year period, 30-year period, 40-year period.
Yeah.
Guess what outperformed at all of those periods of time? Large caps. So is it small caps over large caps, or is it just? I mean, it's not like you're selling your large caps.
No.
You know what I mean?
It's cyclical. If you look at small cap value over the last 40 years, dramatic outperformance over large cap. It depends on the start period and the end period, particularly if you look at when periods get flushed out like this.
And I guess the sub part of small cap as well is important.
Profitable. Yeah, profitable dramatically outperforms unprofitable, and you have solvency risk obviously in some of that index. But if we look prospectively, earnings growth expected to be something like 35% next year relative to the S&P at 13.7. S&P trades at 22.5 times forward, which is a little bit stretched. Small caps, 18, 17, 18.
So would you buy, for example, the S&P small cap 600 over the Russell because it tends to be more profitable, or would you zero in on small cap value specifically? Like, how are you thinking about it?
Yeah, I would be focused here just because of where we are with the easing cycle. I'd be actually skewed towards value because that's where you're going to get the cyclical upturn of the acceleration that's driven by refinancing and the earnings power. The other thing is energy, by the way. You can't give away energy right now. If you believe in data centers, this is the covert AI play. You've got that sector is trading at the lowest multiple in the S&P 500, 15.2 times. It's going to have the second highest earnings growth next year at 17.7% earnings growth. So you can't,
even if oil prices remain suppressed.
Just on demand, okay. There is a case we're moving into the seasonal period where energy starts to outperform in the fourth quarter. So I think you've got to have a little. You haven't had the weight in the S&P this low in energy since the COVID lows when energy turned negative. It's only 3% of the S&P. Every time you've bought that, I mean, we were buying ExxonMobil hand over fist at $33 when oil turned negative in 2020. We see some selective opportunities in energy just like that. That doesn't preclude tech being great, consumer discretionary, but it's like, when these things, generational opportunities are served up, you got to pay attention.
Okay, and so in our last 30 seconds, an individual one of those, Jerry Jones is linked to this one, which you gotta love.
Comstock Resources, look, full transparency, we built a position at $8 and $9 a share. It went to $28. Now it's at $16. New money coming in from clients. We are putting new money to work at these levels.
So what
Why?
makes yes.
Okay. 1.1 million acres in the Haynesville, Bossian formations. This is Louisiana and Texas. It's near the export facilities. It's near the liquefaction facilities. The demand for exporting LNG is going to go up with the trade deals with Europe. The demand in the data center, a lot of data centers are being built in those areas. You're going to have 165% growth in data centers by 2030, according to Goldman Sachs. 60% of that power is going to come from natural gas. Right. They are the lowest cost producer. And Jerry Jones is a master. He was an oil and gas wildcatter. That's what gave him the money to buy the Cowboys. He's got 75%. He says his interest in natural gas is greater than his interest in the Cowboys.
Wow.
And so Comstock Resources is trading at $5.7 billion market cap. That's PV. That's its book value. PV10 reserves. They've got 30 years of drilling rights, which means this could be a $45 stock over the next few years.
I just think it's time to put to bed this constant fear that the AI trade is peaking. I mean, it's done. I mean, every piece of news that we've gotten the past 7 days has been positive.
Yeah, there's definitely a fear that that's what has been almost the sole driver of this market going higher and higher. And so there's this concern that, are we going to get some of the positive sentiment behind AI? Is that going to pull back? And that's going to be bad news for the equity market. But like you're saying, there is support here. I mean, one of the things I've looked at is when you talk about the CapEx with these companies, I was concerned about free cash flow. We have seen that come down a little bit, but earnings continue to support these companies. And so I think when you see these deals being made, when you see the CapEx that's there, when you see earnings support the numbers that are coming out, then I think you have to kind of ride this train and go along with it, not bet against it right now. I mean, NVIDIA is our largest holding in our large cap core strategy, and it's that for a reason. So I do think there's more room to run here, and you want to make sure you have exposure to some of these names in your portfolio.
Victor, let me, as the kids would say, double click. I'm going to double click on what you just said about NVIDIA. What other names, if you own NVIDIA, what else are you invested in when it comes to AI? And do you need to own a basket of AI stocks when you can own NVIDIA and just have that pure play that is seemingly crushing everyone else?
Okay, so it does make me a little bit nervous, Brian, when we want to put all our eggs in one basket for that. So from a pure diversification standpoint, I would say you want to spread that out. But look at the deals that are being made. I know we might talk about that a little bit more later. So I think there are other opportunities that you can have. We have exposure to Broadcom. We have exposure to Qualcomm. We have a little bit of Lam Research in there. There's some other elements within that space that we have exposure to. And I think you want that. It's not NVIDIA is going to be 100% of the game going forward. So there's other opportunities. And as we know, as NVIDIA continues to do well and builds things, it does lift the rest of those stocks as well. So I think there are more opportunities, but it is our largest holding in that space.
It's almost, we're at the point as where, and as a former analyst, I can't believe I'm going to say this, maybe you just ignore for right now some of the valuations on these AI names.
I'm going to plug my ears on that one.
Yeah, because I know, me too. And it's like you just ignore some of the valuations on these names and ride momentum, because that's what we're seeing in the markets.
Yeah, look, I mean, you've seen an incredible run with NVIDIA, with Micron. Look at what's happening with Alibaba. Some of the commentary about Micron was basically the outlook blows out even the highest of expectations. I mean, this just all bodes well for the AI industry as a whole, and the bullishness that Wall Street has had with the AI industry. And I will also comment that, I was looking at some commentary from UBS about AI and the AI infrastructure growth, and they are looking beyond that. They are saying, look, not only does, for example, earlier this week, the NVIDIA OpenAI deal, I know that you'll probably talk about that as well, but look, that has also bled into the need for power, for electricity. So you even saw this week also stocks like Constellation Energy and Vistra, the nuclear theme as well, because this entire AI generation is not just touching the chip stocks. It is also touching the entire industrial industry. It's also touching utilities. So there's many points to this AI theme.
Yeah, Inez, don't give up the rest of the show here. I wrote a big, beautiful segment on NVIDIA later on. I mean, it's like a deep tease. I mean, this is going to be an awesome segment. Brooke, let me get back to you real quick, because you were talking a little bit about Alibaba at the top of the show. If you can, pull up a chart on Alibaba, because I think the market forgot how tethered Alibaba, a Chinese internet e-commerce play, is tethered to the AI trade, because they are.
Yeah, Alibaba this morning seeing a bit of a pop, up about 9%. And when you look at this stock, what we've seen over the recent run-up is really the momentum about how Alibaba is really capturing the key demographic within the China e-commerce market. This is a very digital native consumer. This is a consumer that typically shops majority of time on their phone. They're not going to retail as much as even, of course, the fallback here in the U.S. Now that is a big boom here as well. But this investment, this partnership rather, that they now have with NVIDIA really doubles down their intention to win over e-commerce with AI, be the most innovative. But of course, you can't help but think of Amazon and Walmart, those two players who have really doubled down. Walmart recently announcing Sparky, their AI chatbot as well. So Sparky, I don't know if you've heard of him, but really Walmart and Amazon also getting in on this play. But certainly now Alibaba teaming up with NVIDIA, it seems like every time you hear the NVIDIA get into the conversation, things just got a whole lot more serious.
Sounds like something we got to toss a milk bone to. Throw back to like 1987, Sparky.
Well, futures little changed after all three major averages closed at yet another record high. The momentum trade continuing to power artificial intelligence, gold, and small caps higher. But my next guest says investors should prepare for some volatility and think of any pullbacks as a potential buying opportunity. Joining me now is Jean Goldman, Cetera Financial Group's CIO. So Jean, let's start there. You have called this rally legit. You've noted cyclicals are outperforming. You have bond yields falling. Breadth continues to improve. So where does this tell you about where we're at the current bull market?
Sure. Good morning, Ali. Thanks for having me on your show. The market has had a wonderful run. 2025 has been phenomenal, lots of volatility. But what we're looking forward on a go-forward basis, we do see some type of market pullback. I mean, you look at what's going on. We have high valuations. So the PE ratio in the S&P on forward earnings is around 23. Remember, the tech bubble was at 25. We've got significant market concentration. The top 10 names in the S&P are about 40% of the index. The Fed is going to cut rates, but maybe not as much, given especially the comments we're hearing from different Fed speakers. And tariffs. Think about tariffs. Tariffs still need to either be passed on to consumers as inflation or impacting profit margins. So you take all this into consideration. We do expect a pullback, maybe 3%, maybe 5%. But like we've been telling our advisors and clients, any pullback is a buy the dip opportunity. First of all, we don't see a bear market because you need a recession to have a bear market. The economy looks pretty good. You look at Atlanta Fed's GDP now, it's at 3.4%. We're seeing retail sales come in above expectations. Consumer spending pretty strong. Productivity is rising. Also, as I said, this rally has been legit near term, but you're starting to see market breadth weaken a little bit. Also, tariffs are adding $350 billion in run rate to the economy. That's good news. And most importantly, 2026 earnings look pretty good on the go-forward basis. Stocks start to price in events about 3 to 6 months in advance, with earnings next year for the S&P around 13.5%. That's a pretty good number. Oh, my last point, I forgot about this. $26 trillion of cash on the sidelines waiting for better valuations. All great news. Why we continue to be the buy the dippers right now.
But Jean, we do see stocks at record highs. Markets have even been able to defy that typical September seasonality. So how do you buy the dip if stocks ain't dipping? I mean, what do you think the pullback comes from? Is it all tied to the Fed expectations?
Yeah, I think, first of all, the question is, what do you do while before you have that dip? What we're doing in our portfolios today, we're pretty diversified. I know diversification is an old, kind of boring strategy, but it works. It helps mitigate near-term volatility. So until we see that type of dip, we're increasing our allocation to liquid alternatives, to REITs. We're also overweight other parts of the market that haven't really rallied with large caps, like value, like mid cap, like small cap. Remember, when the Fed historically cuts rates, we tend to see market breadth widen a bit. There's some good opportunities there. From a sector standpoint, we like financials, and then we've also recently upgraded some of the more cautious sectors of the market because we think there's some great opportunities, especially on valuations. Like, for example, we like REITs. We just upgraded REITs. And REITs, given low interest rates, given lower yields, there's some structural tailwinds, especially around e-commerce, cloud adoption, data center, and of course, valuations look great. And then healthcare. I know healthcare has been a little choppy lately, but really attractive valuations and some really good long-term tailwinds driven by aging demographics, managed care, and of course, some innovation around biotechs. So we're kind of positioning ourselves in anticipation of a pullback, being a little bit more conservative, being diversified, and again, exposure to other parts of the market, not just the Mag 7.
So if we don't get the number of rate cuts that markets expect, how do you anticipate that to play out across some of the sectors you were even mentioning that have benefited? And even if you look at small caps, that's really rallied. Do you expect a reversal of that if the Fed maybe takes a pause on their easing cycle?
Yeah, I think if you're Jay Powell right now, Jay Powell, I know he speaks today at noon East Coast time, and he's got a lot to talk about. He's got to talk about inflation pressures. Yes, the labor market is slowing down, but the economy looks pretty good. There's a lot of inflation pressures. There's also some difficulty, I think, in my opinion, for the Fed to build consensus. So this is all taken together. We have this volatility likely to overhang the market. You look at the Fed right now, you've got Hammock and Masalam and, of course, Jay Powell all saying we should pause a little bit and watch the data. But then you have Moran and Bowman this morning, just a few minutes ago, coming out and saying we should cut rates aggressively. There's a difficulty to build consensus. I think the markets are anticipating this and they're waiting on the sideline to say, how does this play out? But regardless of what happens, volatility is going to pick up, and that's where we see the pullback coming into play. But most importantly, we just don't see a big, nasty bear market because historically you need a recession for a bear market, and we've only had 3 bear markets without a recession, 2022, 87, and 1962, and we don't see a recession anytime soon.
So no bear market, but do you think we're at risk of a Meltup in stocks right now?
Definitely. That's part of the reason why we do expect some type of pullback because, again, the PE ratio on forward earnings is around 23. The tech bubble was around 25. And if you're seeing, the Fed cutting rates while the economy is doing okay, yes, I agree, the labor market is slowing down. Part of that is probably driven by AI. AI is taking some jobs away. But at the end of the day, GDP, according to the Atlanta Fed, at 3.4% for the third quarter, that's a great number. And the City Economic Surprise Index is improving every single day. All this in consideration of the economy is going okay. I don't think we need more rate cuts. At that point, with that in consideration, we do risk a Meltup where everyone jumps in and buys aggressively. We worry about this.
And Gene, we only have about 30 seconds, but what's the difference between a Meltup versus a bubble? And are we even close to worrying about a bubble at this point?
That's a tough question at the end of the session. A Meltup and a bubble. Meltup is more of a cautious move higher, but still buying. A bubble is when things get really bad and burst. And we don't see a bubble bursting because, again, there's a lot of cash on the sideline. There's a lot of people waiting on the sideline to jump in with that $26 trillion of money market and savings on the sideline. So we don't see a bubble. We see a potential Meltup, which could push stocks down a little bit later.
It's time now for our investor playbook, looking at software stocks. Joining me now is Steve Koenig, Macquarie U.S. Head of Software and Services Research. Steve, it has been an interesting year in software land, to say the least. With AI coming in more strongly, there have been a lot of questions about which companies could benefit, which might be eaten by AI. And then in the background, all of that is bubble talk as well. And that was the subject of a recent note that you put out.
Yeah,
Are we in a bubble there? What do you think?
Well, good pointed question, Julie. And I think some of the indicators that we look at that point to like risk on, risk off, or investor preferences for growth over margin are at like 24-month high levels in terms of that preference for growth and risk on. So that said, I think we want to be, maybe exercise a little bit more prudence at these valuation levels. But there's a lot of great revenue momentum going on in software now, and certainly a lot of investment dollars are flowing into anything AI related. So, that's kind of the backdrop, and I think investors want to stay prudent, and a stock selection remains very important. But I think that software is a great place to make money, and averaging it over time is probably a great way to go.
Agentic AI seems to be the buzzword of the moment. Is that where investors should be putting their dollars?
Yeah.
And where are we in that? Or is all agentic AI created equal?
Yeah, well, great questions. What's interesting is we did a report on AI disruptors in software. And if you look at the top 60 private companies, software companies, they're all AI native. They're all focused on AI. The large majority of that is large language models, it's platforms, it's tooling, not so much agentic AI. However, if you look at what public large SaaS companies are doing, the large majority of their product efforts are around agentic. So there's a little bit of a dichotomy here. And I think what's happening is the public companies, they are looking to protect their application moats, if you will. They're looking over their shoulder. They don't want disruptors to come in. And there are companies on this private list that are focused on agentic AI.
Is it going to work?
Yeah.
That attempt to protect their moat?
Yeah. Well, I think to the extent, I think the big question right now is, how fast is agentic AI going to get adopted? I think in the near term, most of the adoption is going to be driven by the public SaaS companies that are putting this stuff out there for their customer base. But this stuff is taking time, and that's what investors are realizing as this year has progressed, is like, there was a lot of hype around agentic AI, and the technology is promising, but there's a lot of hurdles. Customers have to get their data in order. Customers need to make sure that these autonomous agents are operating accurately and not hallucinating. Mm-hmm. And so all of this is taking probably more time than investors initially thought. I think to the extent that agentic AI gets adopted, and I think that will happen, I do think the large public companies, at least for the next several years, have the advantage here.
So let's talk about some of your picks. And it's interesting when you talk about moat, because Autodesk stands out to me on that front. We actually just spoke to the CEO of the company recently when they had introduced some new products. Design software company for architects and people doing projects and things like that. Is that why they're on your list?
That is one of the tenets of our investment thesis. I think the opportunities for them in applying generative AI to the design process are really very unique and something different than most of the large SaaS companies deal with structured data. Whereas with design, you've got multimodal inputs, and the idea of having a product designer or an engineer or an architect use text prompts to define the idea, and then to use a multimodal model to flesh out that idea in terms of the building or the product. It's really a unique opportunity for them to apply AI. So we do like that. But beyond that, I think our investment thesis with Autodesk has to do with the fact that we think there's lots of room for margin expansion for them. Their move into downstream construction, into software for field operations is going very well. And I think that they're going to be more focused than ever on getting relationships established directly with end customers as they're changing their transaction model to sell directly to the end customer rather than through resellers. And that creates cross-selling opportunities and opportunities to run sales and marketing much more efficiently.
And I would imagine to capture more of the revenue as well.
Yes.
Datadog on your list as well? Tell me about that one.
You know all my top picks, don't you? I think
I do.
You've done your homework.
I read the note.
That's great. That's great. So we like Datadog. Really it has to do with their market position and share gains in DevOps, and in particular, it's called observability is their category, and it's really about helping software developers and tech operations when they're putting into place new applications assuring that those applications perform properly. And so Datadog kind of created this market for the cloud. You know, there were kind of legacy on-premise vendors, but Datadog pioneered a unified platform for cloud observability. And they've been gaining share in that market. And that market grows very much in tandem with hyperscaler revenue, which had been decelerating, but really has stabilized around 15% growth. And then you add to that Datadog share gains, they have a great revenue growth opportunity.
What I think is interesting, of your top 3 picks, and Atlassian is the other one, the team is the ticker.
Yep.
I believe HubSpot was on your list of top,
yeah,
like a month or 2 ago.
Yeah.
Is that not, do you still like that one, or is it just that you like Datadog better?
No big message there that, HubSpot was not on the list of top 3. It's like we try to look at what's timely at the moment. And I think that HubSpot has some nice drivers. I think their paid seat expansions have been under pressure, but I think that that's starting to improve. And then I think that they're actually handling their Agentic AI strategy well, and I think that will be well received by customers over time. So we still like HubSpot, but in terms of some of the near-term drivers, we like Team and Datadog and Autodesk are the 3 that we want to focus on right now.
Gotcha.
Yeah.
Steve, great to see you in person.
Thanks
for
Julie.
coming in.
Likewise.
Appreciate it. Is this the end or a pause in this FOMO trade?
No, absolutely not. I mean, I think you've got a lot of things going on right now. There's a lot of focus on the Fed and interest rates, and people will try to correlate that to how stocks, particular tech stocks, react. I think this is more just one of those stories where it's run really far, really fast. So to have a pause is healthy, but I think the momentum, it'd be hard to bet against the momentum right now. Do I think some of these companies have probably outpaced themselves? Yes. But when you look at the valuation of some of the companies like NVIDIA, I mean, it's still trading below 30 times earnings now. So, when you look at what they're doing and how they're executing, it should be no surprise that the stock is up as much as it is. I think where you want to be careful are the names that the valuations are just outrageous. It's hard because it eliminates the margin of error when the valuations are that stretched. It doesn't mean the stock's going to go down by any means. It just means that if the earnings come out and it is a disappointment of any kind, that stock is going to be punished fairly aggressively. So I think that's where you want to watch valuation. I don't think it's not going to be the entire industry. You're not going to see it roll over. I think what you're going to see is just name by name that may miss. And, because this is that kind of period where we're trying to figure out who the winners and losers are going to be, because we're still very early. We're probably 3rd inning of this. So we're going to kind of have a long runway of ups and downs.
Yeah. So given all of that too, though, do you want to be defensive on the other side? Like have all that stuff, have the NVIDIAs of the world, but then also be a little defensive just in case? Absolutely.
So we're actually doing what we would call a barbell strategy, right? So, we're still taking that bet. That bet is probably a more defensive tilt on the AI bet, but elsewhere we are playing a lot more defense. We are paying attention more to valuation. We are, looking for those stocks that pay higher dividends to kind of offset, because the growing number of things that could go wrong, the term black swans, seems to be escalating. There's still a lot of geopolitical things that we haven't figured out. You obviously got rhetoric out of Washington, the Fed chair is going to change. So there are a lot of things that could change over the next 6 months, 12 months, that we still like stocks. We just want to be a little bit careful.
Gotcha. What does the defensive side of the equation look like?
Yeah, so in tech, it's going very boring. Microsoft, Google. Right now we're staying away from Apple, or at least underweighting it. But then elsewhere, we're looking at healthcare. Lilly is a name we really like. There's just a lot going on in the healthcare space. There are some shifts, but we still like the weight loss story out of different names. So still heavy in that, but like I said, that still is a defensive play. And then, when you're looking in the consumer side, you're looking at, like I said, it's the more boring names. It's your Pepsis, your Cokes, Procter & Gamble. We think right now, those are the places you want to kind of, like I said, barbell, kind of hedge the rest of your portfolio in those, because that dividend, that means something. If the stocks are going down, that's something you can reinvest as markets may turn over. So, like I said, it's just looking at those lower beta, lower volatility names.
I'm also curious about the U.S. versus the rest of the world, right? Because that trade, the international trade, has really outperformed this year, which is ironic because it was sort of sparked initially by the heaviest of tariffs. The heaviest of tariffs have come off, but that trade has continued to work.
It has.
But, where are we in the sort of sell America mentality that came in that period of time?
Yeah, this trade's similar to value and growth. It's one of those where, growth outperforms, seems like every year, then there's that one year that value outperforms. And this is similar. We've gone a decade where US markets were the place to be, and this is the first year where you're seeing meaningful outperformance out of international stocks. So I think, there's merit to that. You saw a lot of outflows from the US dollar. So, because if you think back to March and April, it wasn't just stocks that were going down. The price of bonds, because yields are going up. And if you looked at the dollar, we look at the Dixie index, that was also going down. So you could see everything that was US was going down because people were pulling the money out. Where were they going to put it? They were going to put it into someplace. So international stocks, international bonds. So that wasn't a surprise. But it went too far. That is one area where we think that delta between US and international just kind of was too large. At its peak, the difference between the two was about 17%, meaning the international stocks were outperforming US stocks by 17%. So we took the bet that was going to collapse. And that trade has been working out. International stocks are still outperforming on an absolute basis, but since April, you've seen that collapse to about 10%, the difference between the two. So we think that's probably going to continue, that shift towards, I'm going to call it normalization. With the hedging, what I'm saying, but it does matter what happens out of Washington, because as we know, something could come out tomorrow. There is kind of heightened rhetoric out of the UN meeting, obviously. And so there could be something else that could push funds back out of the U.S. But right now, when you look internationally, the economic story isn't that great. When you're looking at Germany and the UK, there are a lot of issues, structural issues. So I think it's, for us, it'll be difficult to see capital flows move back out of the U.S. because, once again, where are you going to put it?
Yeah. And then just quickly, I want to end on a stock pick that caught my eye, and that's Reddit. Which is an interesting one, right? Because the company has sort of staked its future in part on AI-related revenue, right? Like kind of selling AI access to its content to train models. Is that one of the reasons you like it?
That is one of the reasons, but it's one of those that people have kind of forgotten about a little bit. It is a decent value. It's trading, once again, under 30 times earnings. So it was a name. It is a little bit of a out of our normal comfort zone, and so that's why we liked it. It's one of those, we're taking a small bet, we're positioned accordingly with it, but it's one of those where we think that when you look at the overall demographic trends of who's using that site, we see a lot of potential for ad revenue, the AI story. So yeah, we just see the momentum shifting back in their favor, primarily because of demographics, the AI story, and the like.
Do you use it?
I do.
Okay. I use it when I Google and it comes up. So sometimes then I end up over there.
The interesting information
Yeah,
website,
exactly.
right?
Adam, thanks for
Thank
coming
you.
in. Appreciate it.